Yes, Vexy is convincing. How you doing, friends? This is Coach Ernie, and this is the final hour show for 0DTE. And this is where we go over, I'm not going to say tips and techniques and all that other stuff. No, we actually go over strategy, tactics, the process, methodology, how to actually make money by betting a very tiny amount and going after a very large amount. That's what convexity is all about, and that's what Vexy is all about. In fact, I wanted to bring her into here, but today we're going to talk about trading in the zone. Now, this isn't like this mental aspect. How do you get into the zone? That's maybe for another show. But today we're going to talk about where the zones are, how do you set up for them, how do you give yourself the best opportunity to land in a zone. All right, so that's what we're going to talk about. And what a zone is, it's really kind of where the maximum payoff is. And then what does it look at like in the middle of that zone and on the outer edges, and how you should treat it. So, but I wanted to start because yesterday I actually started or I ended the show by talking to Vexy and asking her to introduce herself. I tell her because that's the voice that I have. I mean, I suppose I could get Vexy to be a male voice or something, but then I probably wouldn't call it Vexy, right? Right, Vexy? Are you doing okay today? How's it going? We're going to talk about trading in the zone. What do you think of that?
Hey there. Absolutely. I'm doing great, and we can definitely dive into talking about trading in the zone. You can think of me as whatever voice works best for you. Vexy's just fine. So let's jump in and talk about how to stay in that trading flow.
Cool. Well, I'm glad you're okay with me maybe misgendering you or something. Not that you have a gender. Anyways, let's see. We'll put Vexy on hold here a second. And, well, actually, she's probably going to respond.
No worries at all. I'm definitely pretty flexible on that front. No need to worry about gender labels with me. Just happy to be here to help you out. Whenever you're ready to dive back into the trading talk or anything else, just let me know.
All right. So we're gonna talk about trading in the zone today, something that Vexy knows quite a bit about, and perhaps we can have her describe exactly what that means. All right. So, Vexy, can you give us some help here? I want to tell everybody what it is to trade in the zone. Now, this is very different than the psychological phenomenon when you seem to get into this euphoric state and nothing can go wrong. We're not talking about that. We're talking about something a little bit more physical, these actual areas. And particularly, we're talking about how we position trades relative to areas that are more likely to produce profits. So perhaps you can tell me the two things that we're trying to align when we're trying to get in and trade in the zone.
Absolutely. So when we're talking about trading in the zone in this context, we're really focusing on aligning two main elements. First, there's the idea of having a structural alignment. That means you're looking at certain price levels or zones on the chart that historically or structurally tend to be high probability areas for price movement. It's like identifying where the market has a kind of natural path of least resistance. Second, you want contextual alignment. This is about the conditions around that structural zone, like volatility, volume, or macro context, so that you're not just seeing a level on a chart, but also understanding the market environment that supports that level as a good trading opportunity. So in short, you're aligning a solid structural zone with the right context to create a space where your trades have the best shot at working out. That's what we mean by trading in the zone.
Fantastic. All right. She says it so much better than I could. I'll sit there and just fumble over my words. Well, anyways, everything that Vexy knows comes from me. So, yeah, she's my speaking voice. Anyways, what we're talking about is volume profile. Contextual alignment, like you said, would be what's the level of the VIX. That would determine how wide our butterflies are because we're trading out of the money butterflies. And where those profiles are likely to align And is there any kind of catalyst that will push us one way or the other? Now, let's take this morning, for instance, just for context. This is Friday, August 15th. And this morning we had some economic reports that came out in the morning. And they seem to be quite influential on where the market tended to move. Now, and I think the best thing for me to do is to bring up the chart and then start talking from there. And I can show you exactly what I mean by this. All right. So I need to hit the right button here. Come on. Hit there. That's not what I want. I want trading view. All right. So it's in the morning. We do our market analysis. I'm looking at where the VIX is. I see that it's super low. The VIX is this morning was around 14.5 or so. It's risen slightly, but still it's deep in zombie land. In other words, VIX is very low. Premium is kind of scant. It has actually accelerated its decay, so it's giving us less, and that's enticing us to trade a lot narrower so that we're not bitten by the gamma bug. And the other reason for trading narrower is it gets us closer to the market where we're expecting a lower expected move or average range of movement. So the market's not going to move as much, and we want to get closer, and we need to put on a trade that will get us in range. Now, the other thing is we're waiting to see, well, what kind of market catalyst are we going to have, and where is that going to push us? It's going to either push us up or it's going to push us down. We recognize that. And we don't know which way. I mean, the market can respond just about any way it wants based on the report that comes out. And sometimes it's kind of, totally a mystery when you see that a good report might produce a negative market catalyst. But that happens. And that typically happens just by understanding what the general market context is, where the Fed is, what they're looking for in terms of market data so that they can make their future rate cut predictions or future rate cuts. Of course, the market is like 100% kowtowed to the Fed, and almost every decision that the market makes, big decisions I'm talking about, is in the context of what they think the Fed might do. So in this case, this morning, we had a couple of reports that came out. I'll just see if I can bring them up here. Finance. All right. And the most impactful report that we had this morning was the core retail sales month over month and the retail sales month over month. And it came in just about where we thought it would come in. The month over month, the retail sales was slightly below forecasts. The forecast was 0.6. It came in at 0.5. The core retail sales was exactly where it was expected, but it is down from previous months. And but Empire State came in super hot. I mean, really, really hot. Now, retail sales are generally thought as being a top 10 economic report, and Empire State is thought of as being, well, sort of a secondary type of thing. But when it comes in that hot, I think that there's that can be a very strong catalyst. Now, from a Fed's point of view, let me bring you back here. From the Fed's point of view, something that appears to be extremely strong for the market, like Empire State Manufacturing being way up, they think of that as a potential for increasing inflation. That's the way they think. So the market understands that that's the way they think. So that means that there's probably a lesser chance that they're going to lower interest rates. Now, of course, yesterday we also had what some people would call a hot PPI. And the PPI, the Producers Price Index, was very high. It was a 0.9, expecting a 0.3. Now, this is an inflation indicator, but it is subservient to the CPI, which happened a couple of days earlier, and that came in pretty benign. And so the market was pretty much set with that, and I don't think it really mattered what the PPI was going to be, even though it did come in hot. Plus, it seemed to be an aberration. And from a producer's point of view, or from the people who are actually in the cash market, they generally fluff off spikes like this because they're all hedged with futures. So the market kind of fluffed that off and went up. Now today, we're near all-time highs, and the market has two things that it has to worry about. One is this retail sales number, which came in fair to middling, and plus a little bit down. The retail sales month over month was down a little bit. So that's a negative on the market. But Empire State Manufacturing was super high, and that is a real positive on the market, but a negative from the Fed point of view. So now there's downward pressure. Okay. I know that this is also confusing, but if you follow us and you look at our database of economic reports, how we actually evaluate it and so forth, plus you take the market cues and you see what's happening, you'll get a good idea. So overall, it looked like, even though the market is moving up, it looked like there was going to be a bearish bias. Now, I didn't know, and so I started off with a put fly, and so now I have to figure out, well, where am I going to put this put fly? All right. So this is sort of all the setup that we do when we're trying to decide, okay, how am I going to adjust this fly? Where am I going to put it? And what's it going to look like? How is it going to align with market structure? So what I'm going to do is go into the, let's see. I just got to get the chart set up here before I do this. All right. So our market profile, one of the volume profile, one thing that we haven't done yet in any of these episodes is talk about how we actually mark up the volume profile. But let's just say that the edges are super important, as well as these deep crevices are very important. The edges between where the market is trading a lot and where it's not trading that much. You can think of that as being a line of demarcation where there are sellers above that edge and buyers below that edge. And that goes for on either side of these nodes. And that's really where we're interested in. So when I take and I show you all of these lines, you'll see that we start marking up these things right there. Now I'm going to take all the lines off and then just start fresh here. So what we're really talking about is an area up here somewhere. Well, see, the very top of the market is up around here. This deep crevice right there is very important because there's very little trading activity going above that. So there's very little likelihood that we're going to go up and then keep on going up unless there's a catalyst to go up there. And right now we've already decided that most of the catalysts are negative. Plus we had one additional catalyst that we have to keep track of, and that is today, and actually right at this moment, President Trump is meeting with Vladimir Putin, and they're deciding whether or not there can be peace or not. Now, I know that one thing that he said was that he'll be able to tell within the first 5 minutes if they're going to have a peace deal or not, and he'll just walk right out if that happens. I'm sure everybody's watching that door that he walked into. So that had some kind of negative connotation, not because of what he said, but the news media in general are skeptical on whether or not he's going to bring about peace. So that and retail sales are weighing heavy on the market, so it looked like we were going to have a downward move. There's our catalyst. And so pre-market, let's see, we'll put in a vertical line to show you where the market actually opened. That would have been right there. All right. So pre-market, we did succeed to make all-time new highs. And in fact, is that an all-time high? Yeah, I guess it is. Look at that. It is an all-time high in the pre-market. But it got rejected. And then right about here, I'll zoom in on it a little bit. So we made all-time highs overnight. And in fact, right about here is the European Open, right there. And we had some sideways action, and then it kind of sold off. And then we come into the American market, and then right here is where the retail sales were released and Empire State. Now, it looked like it had a slightly positive bent, but then just before the market opened, it was moving down hard. And then finally, when the market did open, it moved down hard. So if we had a bearish bias, now we have to figure out, well, how are we going to position our trades? First of all, we know that there's super low volatility, so we have to be relatively narrow. So the very first thing we're saying is, okay, we're going to be between 20 and 30 wide. Why? Because when we go to our VIX, we're sitting here, 20 to 30 is our choice for things in the Zombieland zone, as you can see there, right over here in the lower left. So let's say we're 30 wide. So the next step is to figure out, well, okay, we know that we want an asymmetric trade. We want to be at the most have the wings of that fly, or the debit of that fly, be 10% of the width. So that means at 30 wide on an SPX, we can't pay any more than $300. We'd like to pay under that. In fact, what we're trying to do is pay maybe half of that or even a quarter of that. I know that sounds crazy, because for a lot of people, that means that we're pushing it even further and further out of the money. And that's exactly what happened. So if you're going to be pushing it down here and maintaining that kind of price, you want to see, well, where am I pushing it? Now, there was a, let's see if we can bring this in. We'll see as we bring in more data. Maybe I'll bring it to a 10-minute chart. Auto fit it. Okay. So we can see there was a substantial node right here. Big node. And so what that's telling us then is that our butterfly should be somewhere near this node. So ideally what we want to do is place a butterfly like down here that's 30 wide. Let's see if I can show you the extent of something. And, of course, it has to be on a strike. So it has to be right on a even number. And because it's 30 wide, that means it's a total, that's 30 wide from the center. So a total of 60 points. So if the top is right here at 64.80, then the bottom has to be at 64.20. So that means it would be about right about there. All right, so now we have our context. Let's just make this so we can use the width to indicate where the close of the market is. And right now, the right side is aligned with 4 p.m. All right, so now we have our butterfly that we want to place in here. Now we only have to find out, well, where can it go? That will give us an appropriate price. Now this morning, I was able to find a butterfly, and it was priced at, here, I'll tell you in a second. What time was that? Put 6,400, 360, 6360. Okay. All right, got it. So part of the problem here is I'm trading SPX, but I'm doing my analysis on the E-mini S&P futures. And the reason why we're doing that is that the SPX has no volume. So you can't look at volume profile. Now, if you do use the SPX and you say, oh, I saw a volume profile on SPX, well, then you're not looking at the SPX. You're actually looking at a CFD, which is contract for difference. That is not the SPX. So we always use the ES. It has volume, and then we have to translate between the SPX and the ES. Now we can see that currently the price of the ES is 64.75, and currently the price of the SPX is 64.55. So there's about a 20-point difference. So if we know then that that if I placed a fly here, and it was at 63.60. Okay, I just had to see where I was at because I don't know where I was at before. So where I was at was 63.60 plus 20 would make it 63.80. Is that right? Or is that 64? It doesn't seem right. I'm sorry. 6,400. 64.20. $64.20 plus 20 is 64.40. Okay, now I got it. So the top of our fly was actually right there, 64.40, and then we need to go down here to, okay, so there's where I could place the fly. Now that might seem like a long ways away, right? And yeah, it appears to be a long ways away, but in the morning, there are two things about this placement here. One is that I can, it's right on this node. So if we do fall down below this node here, there could be a sharp movement in here. At worst, it's probably going to fall through and stay inside of this node. So we have two possibilities. We have a movement down that could find some support there, which it did.
But you've hit the daily limit for advanced voice.
We could find a support right here because it's at the bottom of that node. See, I'll put that little line right there. And notice that it went right down to that point and find support there. And if it did, that would still represent a really good return on our fly. Let me tell you why. If this is a 30 wide fly and we put it on right at this point up here, that means that it traveled almost 2/3 of the way towards that fly. Now, a lot of people are under the mistaken impression that, and this is where I'm going to talk about zones, they'll talk about, or have the mistaken impression that you need to be inside the butterfly in order to capture profit. But what actually happens is that that profitable zone, when I first put on that fly, really starts way up here. So maybe what I can do is show that as a different color, right? So we'll make the we'll make that I don't know, green or white. White is a good color, right? And then we'll make the innards blue. All right. So as price is moving down relatively fast into this fly, we're very close to the butterfly. Now, it never reaches there. However, let's take a look at what that butterfly actually cost. When I put that fly on 30 wide, actually in this case I put 40 wide, it only cost me about $1.25, I believe it was. Yeah, $1.20. So the max profit of that trade, I'm just going to do a little math here, is the width of that fly, let's say 30 wide, minus 1.25 for $1.25. The max profit is $28.75. Now divide it by 1.25, and that means I'm putting on a trade that's 1 to 23. 1 to 23. So when you look at a trade like that, when it's coming down and it's that far into it, particularly in low volatility, you'll find that these trades have already have a great deal of premium decay. So maybe I can demonstrate that in a trade that I can simulate here. I'll put on a butterfly for next week. Let's say on Monday. And I'll put it on right at the market so you can, well, I'll put it out of the money. We'll just show you that. And I will make it pretty wide. So that's 30 wide on one side and 30 wide on the other. Now, I normally will push these way out of the money. Now, this one costs $3.30. So when I got into mine, it was only about $1 and some change. Let's push it way out. Let's push it out this way, and you'll see something very remarkable. So we'll push the outer strike to 30 points out, and we'll push this one 30 points out, and we'll push this one 30. So I'm basically moving the whole thing over by 30 points. All right, so this is more in line with what I did. Actually, it's a little bit more expensive than what I paid. Now, when the market moved towards my fly, here, we'll expand this so it's very clear. This is super important for those that are trading these type of trades, knowing that you don't have to get all the way inside the fly to make a tremendous amount of money. Now, I didn't pay $1.50. I was actually even further out. So let's push it out maybe another 10 points, or let's try 5 points. See if it will get somewhere close to what I actually paid. Nope, still not there. A little bit more. All right, that's much closer to what I paid. Let's say $1. So when it moved towards me, it moved about relatively this far, right? Right about there. And you can see that's about $280 of profit. So if I put in $1 and it's $280 of profit, it's almost 3 times what I paid, or about 300%. So, well, in that case, 200%. That is a really good return. Now, that's what I took. I took something similar to that, and because when it rebounded, I had a certain level of profit. I was within a certain zone in that time frame, and I knew that unless it continued that move, then I wasn't going to see more profit. So what happened was it came down, started to retreat, and then I took the trade off, according to our profit management. When we're in this zone here, outside the profit tent, we call that Zone 1. And in Zone 1, you have a couple of things going against you. First of all, you don't want to spend too much time there. And when I say too much time, you don't want to be there all day hoping that it's going to go into Zone 2, which is inside the profit tent. If it starts to retreat, you're working against two things. One is that you're working against premium decay. So over time, this is going to decay. So watch what happens if I decay, and I'll give a demonstration of what this looks like. So I'll pretend that it's all right. You see how the break evens started way out here. Now it's moved to here, and now that same trade that was once worth $280 is only worth $150. So that would represent what it would look like if you were in the trade at, say, 10:30 in the morning, and if you just stayed there and it did nothing for say an hour, and it would retreat down to and lose about a third of its value. Now, of course, if I held on to it and it did retreat a little bit, it came down to here, then I would have been down about 3/4 of its value. So when I see a move like that into a trade and it doesn't complete its journey all the way into zone 2, my risk is relatively low of it completing that journey into zone 2. So I have to be very cognizant of what is the maximum amount of profit that I have achieved and how much I'm willing to give up. And in that morning time, particularly in zone 2, I have to be relatively on the ball, and once that starts moving against me, I have to take that profit and secure it. It's kind of somewhat opportunistic. If price got into the profit tent, one thing that you'll see is that out here, let's say right at this yellow line, I'm going to go back in time and say it's like closer to that day. You'll see that if my trade is, let's say, right here, right? And let's say it's at $230, and I wait for another hour or two. Actually, yeah. Right? You'll see that it's the break even starts coming in, and the value of my trade is starting to diminish a little bit. As I get closer and closer to the fly, depending on where I am, I have more time to spare. But if I'm, let's go back and we'll see this in a little bit more detail. So let's say I'm right here, right? Here versus here is very different. This is the point I'm trying to make. If I'm here and I've got $143, there's effectively over 100% profit. Now watch what happens. All right. As decay happens, I'm losing money. Now I'm down about 65, 70%. If I don't get closer into the fly, once I get closer into the fly and further in, or closer or inside the profit tent, then my optionality is improving. But as long as I stay out here, my optionality is diminishing dramatically. Right? So that's the first lesson that you learn, that when you don't make a strong move and you get within, I'm going to say 10% or maybe 20% of the edge of your fly, then you need to tighten up your risk management and decide, what is the level that you're going to get out. Because your trade is going to diminish relatively quickly unless you continue moving there. Now, there are a couple of reasons why I didn't believe that was going to happen, and that happens to do with the volume profile structure. So we'll go back to that. And one of those is that it came down and had a quick retreat, and it found support right on this very low level here at what is defining this very large node. All right. that is a strong support area. And you can see a number of places where that has come into play. Over here, it came up and found resistance, pulled back, went through, and then found it as support. And then further over here, it spiked through, but found it as support and launched off from there. And then finally again here, it came down, bounced off immediately, and then came back up. So I'm looking at that level as being really a level that's going to be very difficult to get through. Now, had we bounced through that level and then came up and found resistance from the bottom, now I would have been in much better shape and much better position to hold on to that trade, because now I am in this latter third of the outer zone. And I can look at price actually, or theta, working in my favor. Once I get beyond that zone and just happen to line up there, now theta is working against me. So there's a point where you have to understand how exactly how theta grows and relative to your trade, and also where your positioning is from a structural point of view, so you know what kind of backstop that you have. And here I didn't have any backstop. In fact, the trade got sucked right back up into this large node. The node has a lot of gravitas, or affinity. A lot of people like to say it's price affinity, and it likes and it finds value there. Now, a lot of people will say, well, why didn't you just put a trade right here, Ernie? Well, that's great. Now, I could try putting a trade right there, but that would violate one of our principles. And let me show you how that works. So, as you can see right here, we'll put where that node was relative to this. Sorry. That line was at 64.61, and on the SPX that would be 64.40, because there's a 20-point difference. So now I'm going to go back to my Thinkorswim and show you exactly where we were on there. So in the beginning, 64.40 was right here. Now this isn't to scale what actually happened on my trade. My trade, because I'm just using an example, this isn't what happened this morning. We'll just say that 64.40 was right about here, or the bottom of that node. And that's where I knew that there was strong support. So price came through here. I was expecting it, if I was going to have a chance at a much larger trade, it would have to break through there and then find resistance there so that it could continue this way, but it didn't. And by being right here as opposed to right here, I knew that I was going to, or anything below here, I knew that I was going to suffer negative theta as opposed to positive theta. And so that's really what I'm looking at. Negative theta out here, positive theta out here for a time being. Now there is a point where, as this grows later and later in the day, where this positive theta will last for a little bit. So you can see it'll go up, up, up a little bit, but it's starting to pivot. And you need to get closer and closer to your butterfly in order to continue to be a benefactor of that positive theta. And ultimately, you need to be inside the profit tent in order to get positive theta. So while you're anywhere where the outer strike is or in, you're going to get the benefits of positive theta. Anything to the outside of it, that zone, you're going to be negative theta, and your time is limited. So these are the things that we're looking at. Position relative to our market position relative to the strategy, and also relative to the underlying structure, which will determine our fate and what our risk is. So I determined that I was too risky out here. I had to exit the trade, which is fine. Small trade, no big deal. It just so happens that this whole week has been like that. Small trades, just getting right on the cusp, ready to break through, and then turns around and does nothing. Now, of course, when I'm trading more than one position. So, it's still a substantial trade, but still not enough to say, hey, this is going to elevate my account to new heights. But it keeps me in the game. And even if I lose, I've taken such small risk that I'm in no real danger of busting my account. Now, I'm trading with a fairly mid-size six-figure account, well over $300,000. So a trade, even I had I believe it's 6 positions on. I'm trading $600. What is that as a percent of my total trading capital? So 600 divided by 325,000. So I'm only trading with 0.18% of my trading account. Super, super small. Now, for me, this is kind of a test trade. I'm seeing if I'm going to have a breakthrough here, and if I do, that's great. If it moves further, that's one thing. If it moves it back, maybe back to another structural level, I can look at maybe another trade, probably a smaller trade, to see if I can capture a little gamma action. But as far as a first trade goes, that's typically what I end the day with, and I say, okay, there's nothing else to do. I've made a little money, didn't lose any money, and but didn't make the big kahuna. Now, if had it moved into here, this is a relatively low probability event. Most of our trades only move into the butterfly about 13% of the time. However, you can make quite a living right out here outside, where you can have returns as much as 400%, maybe even bigger, maybe up to 450%. But once you get inside here, now your returns can reach 2,000, 2,500%. But I'd be happy with making 2, 3, 400% on a fairly consistent basis, more than 50% of the time, because that more than outweighs my losses, which are very small. And then those few times that I get in here, which we call zone 2, it's a completely different story. My risk tolerance totally changes. Now I am looking at where I am in the day, because as long as I stay near the center of the trade, I'm pretty good. I have relatively low gamma, almost near zero gamma. But as soon as I get onto the edge of the trade, and as time moves on, this curve is getting steeper and steeper. In fact, it's starting to take on the same shape as the blue line here. And you can see that once you get very late in the day, and say the top of this profit loss curve is up here, then I am now experiencing extreme gamma. And so if price were to move out to this edge, as soon as it touches and gets a little bit beyond here, let's say later in the day, I could easily lose $500 with just a 3-point move, right? So I don't want that to happen. So I'm protective of that area. My spidey tingly senses go way up, and I've got my trigger finger on and ready to take those trades. Now that's the case in low volatility, and the reason why I'm making it seem like it's touch and go in low volatility, because it is. In low volatility, we have to trade narrower, and for a lot of different reasons. But the main caveat of trading narrower, or the plus, is that I can get closer to the trade and I have at least a shot. But staying in the center of the profit tent, or getting into the profit tent, is still a low probability event, and it's very risky. When we're in high volatility and we're trading with much wider flies, instead of trading 30 wide, I might be trading 50 or 75 or 100 wide. now I have lots of room to move back and forth. And I get inside this tent or anywhere near it, and it just feels like a beautiful open field. And I've got plenty of time to make these decisions. So high volatility is actually a much lower risk situation for us volatility traders, us premium collection traders. All right, let me go back to the big head to see if I can answer some questions. All right, everybody's telling me, oh, you can't see this, you can't see that. Well, hopefully at the end that you can see everything that I was showing you, right? All we see is a lovely white dot on your chart. You are not showing the risk profile screen. Now we are talking. Okay. Now, what I've got to know is, when did everything go well? Yeah. So I'm pretty sure I had a pretty good handle on that, and I was showing you everything all the way through. What is your preferred time frame for these trades? 0 DTE, 3 days. Oh, I see. What is your preferred time frame for these trades? 1 or 3 days, etc. All right. Good question. We have the time frame really dictates the strategy that we're using. So let's put it this way: for various time frames or time spans, we have different strategies. At the shortest time frame is what we would call the 0 DTE trade, and in reality, it can go out to 2 days. But most of the time, it is a 0-day, only that day trade. And I've been mostly talking about the 0 DTE trade. I think it was it yesterday that I talked about time warp and started to get into the extreme cases for 0 DTE, where we take on maybe an additional day or two because of extreme low volatility, like we have now. And I might go out more days than that. And the reason for that, if you go back and look at some of my previous shows where I talk about how premium, the rate of decay, is tied directly to the level of volatility, or the VIX. And it's funny, that particular show, which is perhaps the most important piece of information for an options trader, is the level of volatility and the rate of decay, also got the fewest amount of views. And I've got to wonder, I said, well, why is that? Is it that people are ignorant as to how important volatility is to the rate of decay? Do they not care? But that is everything. So I'm here to tell you right now, if you're avoiding shows like that, then you're avoiding the most important thing that's going to assure that you're going to be a profitable trader trading 0 DTE, is understanding the effect that volatility has on the rate of decay. It'll determine everything. The rate of decay will determine your trading zones. It will also determine how much you're willing to risk and what your risk will be. And it will determine whether or not you need to go 0 DTE, 1, 2, 3, 5, whatever. All right? So the most basic trade that we have is a 0 DTE trade, and it is from 0 to 2 days. The time warp brings us out an extra 2 days, and we still follow a lot of the same constructs. The next level we call the convex stack. These just a name. We like it because we're convex traders, and so we call it the convex stack. But it is like an extension of 0 DTE and a lot of the criteria that we use for 0 DTE is also used for the convex stack. So in other words, we decide on width and we look very closely at volume profile. And so that is 3 to 5 days out. And you can use convex stack also in conjunction with expected events that are happening. You know, for instance, like today's event, the Anchorage Accords, or Trump speaking with Putin right now, is a really impactful event, and it could have a lot to do with what's going on in the future markets. In fact, if they come to some sort of agreement that they're going to head towards peace talks, then I'm sure the market is going to respond very positively to that, otherwise very negatively. Now, I would also expect that we would hear something later today. Now, that might affect Monday, Tuesday, Wednesday of next week. It will likely affect that. So in that case, we would use the convex stack trade, which is 3 to 5 days out. So Monday would be 3, Wednesday would be 5. So you might put on one of these positions on Monday or Wednesday for an event like that. You might also look at other impactful events like the FOMC meetings that happen periodically. There is one coming up in September, and there will be one, I believe there's one in October, and other events that are even further out. When you're looking at things that are even further out, you might want to think about using our next stack or trade, or use it in conjunction with convexity stack we call the sigma drift, and that goes from 5 to 10 days out. So you could look at rate cuts all the way out and think, okay, I'm going to plan for this a month ahead of time and position myself for what the market is anticipating and what I'm anticipating, and play both sides of the market, and then just kind of layer it in and capture all that premium. So that's a very typical thing that we do with the ones that are further out. We'll put a 10-day DTE butterfly, and we'll put it on every 7 days. So now you have 3 days of overlap, right? Boom, and it's all overlapping. And we'll push this out far enough so that it costs very little. And we'll capture all of the big moves that happen in there. Now, how many times do you get big moves? At least 20-25% of the time, you're going to get something that's close to a standard deviation or greater move. And then those trades will pay off big. And I mean very big compared to the amount that you put in there. So you might put in, typically for a 50 wide trade, you're paying around 70 cents. So on a 70-cent trade, let's do the math. 50 minus 0.7 divided by 0.7 is a 1 to 70 trade. That means for every dollar that you put in, you're potentially going to make $70. Now you get inside of a trade like that on a good move, which is going to happen about, like I said, somewhere around 10% of the time. Maybe a little bit less, maybe 6% of the time. So in other words, it's going to happen out of 200 trading days, 220 trading days. Time. It's going to happen about 13 times a year. All right. So in other words, about once a month, and it's not going to happen regularly once a month, but about once a month, you're going to get a big trade that's going to move inside one of these tents. And that $70 trade is going to be worth, I don't know, somewhere between $1,500 and let's say $4,000. Now let's do the math. Let's say that you put these on once a month, or once a week. You put them on once a week. A $70 trade, and then perhaps you intersperse 2 other trades during that month. So you put on a total of 6 a month. You pay $70 each time. So that'll come out to about 72 trades, right? So 72 times $70 means that you're going to commit about a little over $5,000 for that year. Now, I would say about 38% of the trades are going to be small to medium winners. 50% of the trades are going to be losers. So we know that 50% of the trades, or $2,500 right off the top, are going to be losers. All right? So, and then the other 37% are going to be pretty big winners, usually somewhere around an average of 2.5 to 3 times what you risk. So let's say $210 and 38% of the trades. So that's 36 times 210. All right. So now you've already made $5,000. All right, just on those. And then approximately somewhere between 6 and 15 of those are going to get in or near your trade. Some of those are going to be big winners. Let's say then they average around plus 6 times, let's see, 1,800. So now you're talking about a potential or average gain of about $14,000 to $15,000. So that's a realistic expectation with a sigma drift trade. And I've shown a Monte Carlo simulation where that actually pans out, where I've run the simulation 10,000 times. I show what it looks like in real life. In real life, it's really going to depend largely on the market context. So right now we have super low volatility, so I probably wouldn't expect the frequency to be as high. So you'll still likely make money, but it's going to be smaller. But in any case, you're only committing $5,000 and potentially doubling, tripling, or quadrupling it in that time frame. So that's the real advantage of that. However, the times that you're not making money, your account is going to go sideways like this and slightly down, a slow bleed. So that's what you have to look forward to in the sigma drift. The 0DTE is much more active, and you'll have a smaller wins, some big wins, but you'll be going more up this way. You'll be kind of stair stepping like this. I kind of showed that in yesterday's show. All right. I don't know if that answers your question. We have different trades: 0DTE, convex stack, and sigma drift, which convex stack and sigma drift are more like our swing trades. And then we have other trades that go even further out than that. And if you have a portfolio, then we would use those as kind of like insurance for our portfolio for those events that don't happen quite as often. All right, there you go. Hopefully that was informative. Trading the zone is something that I'd love to teach to you. I'm going to create a download that I'll put in the description here. Please look for that. I'll talk about it on Monday as well. And it will teach you how to recognize when you're in that zone and how you should behave while you're in there. All right. Thank you all very much. Time to go. Yes, that is. Please hit the like button if you like this content. Share this with other people and subscribe to the channel. Love you all. I hope you all have a great weekend. Take care. Coach Ernie is out.